Hi, my name's Emma, Product Research Director at Ascentive. As an Ascentive Trade Map subscriber, your success is our highest priority. That's why we created this brief video to help you understand the basics about futures investing. Investing in commodities can be an important way to diversify your investments beyond traditional stocks, bonds, and mutual funds. So first, let's be clear on exactly what commodities are. Commodities refer to any resources which are uniform and considered to be basic goods, from the grains which make up your breakfast cereal, to the precious metals in your car's catalytic converter, to the gas and oil that fuels it. Commodity prices often fluctuate widely because of changes in their supply. For example, when there is a big harvest of a certain crop, its price usually goes down. And when there's a drought, prices often rise because of fears that the supply will drop. A futures contract is an agreement to buy or sell a specific amount of a commodity at a specific price, on a specific date in the future. This allows a business or individual to navigate risk. Even though prices are always changing, a futures contract locks in a fixed price to buy or sell at a future date. This reduces the risk of being negatively impacted by price change. Using the coffee industry as an example, if the price of coffee beans goes down, it's good news for coffee shops, but bad news for coffee farmers. However, if the price of coffee beans goes up, the tables turn. With coffee futures contracts, both coffee producers and coffee drinkers are able to lock in prices ahead of time. Say you're looking to buy a new home in a year and you're afraid interest rates might rise and increase your mortgage payment. You could offset a potential interest rate increase by trading interest rate futures such as the 30-year U.S. Treasury bond or 10-year Treasury note, depending on your time horizon. Another use of futures contracts is to allow traders to speculate on the price movement of commodities, currencies, stock market, indexes, and other assets. For example, when you consider the changes in the price of a commodity like gold, the futures trader can potentially profit by correctly estimating the direction that the price of gold will move. But if the futures trader estimates incorrectly without protecting her risk, she can lose the entire investment and more. Now that you know how futures investing can be used, let's look at the key components of a standard contract. These components are called contract specifications, and they are widely available everywhere futures are traded. First, there's trading hours. Futures markets are open virtually 24 hours per day, 6 days per week. However, each product has its own unique trading hours. Next, each contract specifies something called the tick size. Tick size is the minimum price increment a particular contract can fluctuate. Tick sizes and values vary from commodity to commodity. Then there is delivery. This is more commonly called the expiration date and occurs on a commodity's last trading day. Contracts are settled either financially or physically. An expiring crude oil contract calls for delivering 1,000 barrels of crude oil. However, don't be worried about 1,000 barrels showing up at your front door. Your broker will not allow clients to take physical delivery. You are required to close the position before the delivery date, and if you don't, it'll be closed for you. A fourth standard component is contract size. Each commodity has a standardized contract size that doesn't change. For example, one standard contract of crude oil always represents 1,000 barrels. Its mini-sized contract is 500 barrels and its micro-sized contract is 100 barrels. One contract of gold represents 100 troy ounces. An S&P 500 futures contract represents $50 times its current market index price. Finally, because of these contract sizes, the last contract specification to be aware of is the overall total contract value. And this is possibly the biggest mental shift that investors who are familiar with trading stocks need to make. When trading futures, you always trade with leverage. The contract value is the current price times its contract size. For example, as I just mentioned, the E-mini S&P 500 contract is 50 times the current market price of the index. If the index is priced today at $2,250, the value of one E-mini futures contract would be $112,500. To open a position in a contract, the required initial margin is the cost of entering the trade. It's how much money you must have on deposit in your brokerage account to open a position. A slightly smaller amount, called a maintenance margin, must remain on deposit in your account as long as the position is open. This initial margin of a futures contract is often somewhere around 3 to 12% of the futures contract value. This means that you will control 8 to 33 times more capital than you hold in your account. So although you may be controlling a contract worth $112,500, you've essentially put up a deposit of only around $10,000. If the total value of the contract goes up only 1%, the value of your position has increased by 10 times that, 10%. I hope this gives you an idea of the power of futures investing. If you're new to trading futures, relax. As an Ascentive Trademap subscriber, you're taking your own investing expertise to an entirely new level that can dramatically grow your returns and substantially propel your personal wealth. You're always in the driver's seat, and Ascentive Trademap is a lot like your car's GPS guidance system. Pay attention to what it says and then use it to guide your own investing success. Thank you for joining us, and be sure to visit our other videos on becoming more and more of an experienced and knowledgeable futures trader.